All right, let's get going. Relatively small class. I think I kind of got everybody's names, but if I happen to call you by a wrong name once, don't get too mad at me. You gals, I got you sorted out, okay? I got you figured out. Even though you're both kind of blonde-haired, you know, I can tell the difference, and so it's not too tough. That's unusual to have a class, you know, with this much of a dominant guys versus gals. It's typically been kind of the opposite. Usually it's closer to 50-50, but usually, if anything, there's a few more gals than there is guys, but who knows? So, okay. Today, like I said, we're going to launch into a little bit of Chapter 1. This first week and a half is going to be boring and old-fashioned and a little lecture. You know, try to get through Chapter 1 partially today, finish it up, maybe start Chapter 2 a little bit. And then by, you know, next week, we'll kind of get this thing flopped and turn it over. By that, you guys should be going in and looking at some of the problems that I have for Chapter 3, maybe even listening or watching the videos, okay, ahead of time. So when you get here, you can go to work on them and then get help as needed, either from myself or from your classmates, either one. So, okay, that would be the premier way to do it. I would say also that if you get to the point where you start not showing up for class because you think you got everything handled, and then all of a sudden something goes awry and you're having a problem and you want to come in and take up my office time when you should be doing it in class time, I'm not real sympathetic when it comes to that. So, okay, class time's kind of set aside for that. So, be here if you get your stuff done, everything's going good, so be it, okay? But if you need some help, this is the time and the place really to get it as we work on these things, both on the problems and on the projects as we get those going. So, yeah. I see one overachiever who will remain unnamed but isn't in the classroom has already submitted their Project 1 business idea. So, man, I tell you, some people are just overachievers. Yeah, it's horrible. Anyhow, so Chapter 1, is really, like I said, it's kind of a review. Hey, Thomas? It's a review of a little bit of business law, a little bit of accounting, a little bit of stuff, but also kind of an introduction into why we do finance, how business finance came around and why we do it. And I think it's a good background. It doesn't hurt for us to talk about it. I give you my little spin on it, why I think some of these things are important, etc. So, away we go. Oh. I put that on there as a reminder. You guys have maybe seen some posters around. There is a club, and it's not limited to business students. It's open to anybody. Any major can be in the club if they wish to. It's called Business Professionals of America. It's a good club. They meet once a week. They do some projects. They do some things. They usually raise a little bit of money, and they do some good traveling to contests that they do, I think every spring, if I'm not mistaken. I think last year they might have gone to Florida, okay, something like that. So it's a business club, obviously, but anybody can get in there. It's a great resume builder, okay, especially you go to competition and you have some success there. They also go around the state. I think they have some other smaller little get-togethers and whatnot. So great resume builder. If it's something that you're interested in, you can see me. I think Chris actually is the advisor for that club, and he's still gone for a bit. He'll be gone for a few days. Anybody in here that has been in that? Luke's been in that. Erica, you guys? Okay. Am I kind of saying it right? And okay, because I haven't advised it or anything, but you guys want to make a pitch or anything for some more members, or?
Erica went to the actual competition. I didn't go there.
Yeah. Was that fun?
That was really fun. We went to Anaheim this year.
It was Anaheim, okay.
Yep.
Okay, the year before I think it was Florida maybe or something like that. So, and it's not just all business when you go. You get some
We went to a baseball game. So
Ooh.
that was fun.
Who was playing?
I think they were playing Kansas City.
Yeah, okay, be all right. I can remember going to that stadium years and years and years ago. So yeah, okay. So there's my pitch for BPA. You guys, you'd like to see more members in there, wouldn't you? So yeah, kind of share things. So okay. Relationship between finance, economics is kind of that old science, that old social science, right? And accounting came along. Accounting's a way to keep track of things. Wonderful. We have income statements, balance sheets, and statement of cash flows. You guys might, I don't know that you get tired of those as the semester goes on, but we'll be looking at some of those things, especially as we get into project 2. You know, those are kind of the primary financial statements that you look at in banking. OMG, that's when you get up to being a lender, either a small business lender, an ag lender, or whatever. You spend most of your days doing that. You know, in addition to consulting with customers and whatnot. So they're good stuff to know, and it's stuff that you'll want to know as you get into other professions, not just banking either. It was frustrating sometimes as a banker when your customer didn't know anything about those things, right? And you had customers, sometimes they were intuitively pretty good business people, but they'd come in and sometimes they'd even bring those in and they didn't know anything that was on them. And I'd say, how do you make good decisions, without understanding what's in these financial statements? And for some of them it was tough. And a lot of businesses failed because they didn't understand, kind of a little bit that was in these statements. So they're important. Economics, I think I'll talk a little bit more about economics as we go along here just in the next slide or two, but finance links the economic theory with the accounting numbers. So we got those types of things going on, and what do we mean? This one's kind of pertinent actually to today. It's probably from several years back, 2011 it says on there. But this is kind of going on right now. We're hearing, you guys don't watch the financial news like I do. I watch CNBC, until about 5 o'clock if I happen to be home. That's typically which is the NBC's financial channel. I watch that typically. And then I'll turn into some other news typically in the evening. But in any event, there's something that happened here just recently that sometimes they say is a precursor to a recession, and it's called when you get an inverted yield curve. Okay, and typically, a long bond, like a 30-year bond, is going to have a higher rate than, say, a 2-year bond. Okay, when the yield curve inverts, that 2-year rate might actually be higher than the 30-year rate. Okay, I think what's inverted here lately has been the 2-year and the 10-year bond, and I don't know if that's been as reliable a predictor of recessions as the 2 and the 30, but yeah, I'd have to go back and look some of those things up. Okay, so those things are kind of interesting. It has been, like I said, a fairly good predictor, but I've also heard some commentators oftentimes say that the inverted yield curve has predicted 9 out of the last 5 recessions. So it kind of gives you a little bit of insight into can happen. In the 1900s, finance actually emerged as a separate field. People started getting into that. People were hired as financial managers and whatnot. Financial practices revolve around capital preservation. So when you're a company, you want to preserve what you do have, right? As an individual too. Okay, hopefully you will. Liquidity. What's liquidity when we talk about businesses or personally?
Having cash available, or
Yeah.
being able to do things with it, not having it tied up.
Yeah, exactly. It's not invested in equipment, machinery. It's actually maybe in the bank or access to cash that you can use to make immediate purchases and whatnot. That can be a huge thing. If opportunities arise, it's kind of nice having that cash so you can take advantage of those opportunities. You guys will hear me talk about Berkshire Hathaway probably too much, but right now I think they have $125 billion on hand, and Warren Buffett's famous for coming up with purchases and whatnot, but especially when the economy starts, if a recession comes along, he's just going to be sitting there going, ooh, there's going to be some bargains. That's exactly what he'll be looking for, right? Last I knew, and I haven't looked it up lately, but Apple had about $275 billion in cash on hand. Can you imagine that? A huge, huge chunk of change.
What's their net worth? So you have that much on cash.
Well, net worth, if you're doing it on a book basis, my guess is it's $400 billion or so, not as much as you might think. It's not a real capital-intensive business. In other words, they don't have a lot of plants and those types of things. They outsource a lot of that. But I don't know. Their market value, that's a good question that he asked. It's a good time to kind of bring it up. Market value is close to $1 trillion. Well, what's the difference between book value and market value? Okay. Book value is what the accountants say you're worth. You know, they add up the equipment and that type of stuff that you've purchased, the cash that you have on hand, the other investments that you might have, the inventory that you have on hand, your accounts receivable. They add up all those things, and they subtract any debts that you might have against it, right? Okay? And you got to figure in depreciation and a few other things, but that's your book value. Market cap, or market valuation, is what the market thinks that the company's worth, right? So when he asks what I think their net worth is, I'm guessing it's 400 or 500 billion, maybe somewhere's in there. But their market value, last I knew, is pretty close to $1 trillion. Okay, Apple and Amazon, I think have been the only two companies that have breached the $1 trillion mark, and I think they've both kind of gone over it and then come back a little bit, but they're hanging right in there at about that trillion. If we have a little time, we'll try to quit before the end, and we can look that up. Okay, it's pretty easy to look those things up, so we can do that. Some reorganization of financially troubled corps, and then bankruptcy processes. We don't like to talk about bankruptcy processes too much. So I can say, though, in banking, one of the more interesting things I had to do oftentimes was kind of get involved in some bankruptcy things that were going on. You'd have a customer that might file a bankruptcy, and you got to protect the bank's interests in that case, right? And it was never a good thing because the bank's always going to lose money. You never come out of a bankruptcy even. You're always going to lose some money. But the processes were they were interesting, to say the least. So I don't want to say fun, but it was just kind of one of those learning experiences that was kind of neat to go through, I guess. Finance becomes more analytical. Well, we develop more tools probably to become more analytical. You know, financial capital, money, whatever that you might use to purchase real capital, which are equipment, machinery, those types of things. That's what I said. Apple's not terribly capital intensive, right? Microsoft makes, software. They don't have a lot of capital tied up in that, right? It's not like John Deere that has to have big manufacturing plants to make big equipment and those types of things, right? Okay, so differences in how they operate, okay? And so financial management becomes different for those types of corporations, what's important and what's not. Cash and inventory management. Inventory management's a huge thing. Probably one of the things that, if you talk about Walmart, what's made Walmart successful? Their ability, one of the big things is their ability to manage inventory, right? Great ability to manage inventory. Get it to the counter, get it out the door, not have to, just-in-time inventory. You talk about those things in some of your other business classes. Those are some of the biggest advances that we've made. They're in the background. You and I don't see them, but they're some of the biggest advances that have been made, in retail and wholesale in the last probably 10, 20 years. And that's technology, right, that's allowed us to do that. Capital structure theory, debt versus equity. It's basically that. Debt versus equity. Are you going to borrow money to do your things, or are you going to have, mostly equity to do those things, right? Apple probably has a little bit of debt. You're always going to have like deferred taxes. You probably got some accounts payable. You got a few things like that. They may have some bonds outstanding too. Maybe, some different thing. But it's probably pretty minor. So they're using equity to finance just about the whole thing. Other companies are going to use a lot of debt. A lot of companies that are capital intensive, if you looked at John Deere, for example, or BNSF, which is owned by Berkshire Hathaway, so you couldn't break that out. But, they probably use a decent amount of debt to finance those things. You'll hear me say this, and this has become a little less so, but I've said it for the 17 or 18 years I've been teaching up here. Debt is always cheaper than equity. Okay, debt is always cheaper than equity. You kind of think, well, equity, that comes out of my own back pocket. That's pretty inexpensive. Equity's expensive, okay? When you talk in the public world, when you're trying to raise money, okay, you can issue bonds, and you can do that overnight, and you're paying what right now? The government's paying 1.5% for a 10-year bond. A good corporation, a AAA corporation like Microsoft, pay 1.6, 1.7. Microsoft's actually got a better credit rating than the U.S. government, so they might pay less than 1.5, okay, for a 10-year bond. And they get to write off the interest, right? So they get to deduct that a little bit on their taxes, and so that's pretty cheap. Equity's not that cheap, right? The investors expect a lot more than that. Okay, so equity's a little bit more expensive. So, dividend policy, should we pay a dividend or not? And I added this just today. I was kind of going through this slide, and I said stock buybacks. That's been a big deal in the news quite a bit lately. A lot of your more progressive presidential candidates say, God, corporations shouldn't be allowed to buy back stock. Some of them actually want to ban the practice. I could rant and rave for a whole day about how stupid that is, but I won't do that. You guys probably get tired of listening to it, and I'd really get on a rant and a roll. But stock buy. What's Apple going to do with its $275 billion in cash? Okay, they can do anything they want in terms of paying, research and development. That's already in their annual budget, right? And they could double those things, and they'd still have plenty of money, right? What are they going to do with their $275 billion in cash? They could buy other businesses, but would it make sense for them to buy John Deere, for example? They'd completely fail at that, wouldn't they? Okay. There might be some related businesses that they could buy. Some of them are just tiny, They could buy Uber for, they wouldn't even blink an eye, and Uber's worth $50 billion probably. Apple could buy Tesla. They wouldn't even blink an eye. Okay, so they could do those types of things, and they might kind of be related, but it's not necessarily their expertise. It's not necessarily good use of capital, right? Maybe they're better off giving it back to the shareholders with stock buybacks. Let them go invest in Tesla, or let them go invest someplace else. So, they get kind of a bad rap from some people, if you really study stock buybacks, so they're not a bad thing at all. And we'll talk, especially when you get into Project 2, we'll talk about stock buybacks. You guys will probably, some of you will pick some companies that have done some stock buybacks. Microsoft for the last 20 years now has been buying back just copious quantities of stock because they're kind of like the Apple thing. They generate a lot of cash. They can invest anything that they want to invest in. They've bought a lot of companies. They bought LinkedIn and they've bought some other companies, right? What do you start doing with the cash? So they've bought back a lot of stock. And you can see that in their financial statements, their cash flows especially. So some modern issues, right? Risk-return relationships. You'll hear me say this, kind of like the debt equity thing. Risk and return always go together, always. Okay, never separate the two. They're always together. Okay, if you get that thing in the mail or your email or whatever that says, boy, I'll tell you what, you can get a 17% return. Absolutely, it's 17% and it's virtually risk-free. Just turn and run like hell, okay? If it's 17% in today's day and age, there's no way it's risk-free, okay? No way in hell is it risk-free or even close to risk-free. It's riskier than all get out if it's 17%, okay? And so those things always go together. Risk and return always go together. Okay? Maximizing return for a given risk level, yeah, sometimes we're willing to take on a little more risk. Sometimes we borrow a little money maybe. A company may buy another company and they take on a little debt to do that. That's going to increase their risk, but that debt also reduces their capital and their equity capital, and so you might get a higher ROE as a result, and the return might be better. It might be better for shareholders over time. Okay, having a certain amount of leverage actually does increase ROE. We'll talk about those relationships as we go through the class quite a bit, right? But if you've got leverage, if you're borrowing money, that's part of your capital structure. Okay, that can help your ROE go up big time. Okay, but it's also more risky, right? You got to pay back that debt. Somebody's going to be knocking on the door. Portfolio management companies, I have no idea how many people Apple has working for them that do nothing but invest that $275 billion or whatever they have in cash. Okay, no idea, but they've got a horde, I'm sure, of people that's what they do is work at investing. That's their portfolio. We ran in at the bank. There were times of the year, especially, when we would have excess cash. Okay, typically in the winter. Because banks, you lend a lot of money out in the summer when farmers are farming, and they pay you back in the fall. And so during the winter months, we had to keep it pretty liquid. We couldn't invest that in 10-year bonds because next spring we were going to need it again to lend out to the farmers. So it's fairly simple, but that was a big part of the job too, is keeping that that cash invested during that period of time. You didn't want to get nothing for it. You didn't want to just leave it there. So you'd go buy some bonds, short-term bonds, or do some things like that. And the capital structure theory, again, gets back to debt and equity and those things. So hedging gets a little bit of bad rap, but often I get farm folks in this class, a lot of us have farm and ranch backgrounds, and most of you, how many of you guys are farm ranch backgrounds? Yeah, about half. Okay. So do your families use hedging? Do you know? Yeah, he's nodding for sure. The rest of you are kind of looking at me like, it can be as simple as this. Let's say it's April and you forward contract your wheat. Okay, you're going to grow wheat and you forward contract a couple contracts, so 10,000 bushels or whatever, and you do it at $5 a bushel. What might you do then that would be a hedge? You might go out and buy, I think if I get this right, I'm not that good at the options markets or the futures, whatever, but you might buy a call option then, okay? Because what you want to do is you want to protect it in case the price goes up to $10. You want to be able to take advantage of that, right? And I think that'd be a call option if I'm not mistaken. Yeah, Luke's nodding, so okay. Yeah, so you could sell the grain. You physically sold it. You're going to deliver it at harvest or shortly after harvest or in December or whenever the contract calls for. But you've also then gone out and for a little bit of money, you've bought a contract that says if the price happens to go up to $10, you can get paid for that. Okay. Costs you some money, but if the price does go up, okay, and we don't. If you want to take a class like that, Danley used to teach. I don't know who teaches it now. If Brianna's teaching that, yeah, okay. Agmark, yeah, and that'd be good. The same thing works with stocks. Okay, you can do that. Interest rates. Okay, if you were borrowing money and you were concerned that rates might go down. And so your rate's too high that you could protect yourself, right, by going into the futures markets and doing some things like that. So so you can do some hedges. A lot of hedges are very, very legitimate, and they're just a good way to balance some risk, actually reduce risk. A lot of people get carried away too with that, and they get into those. They start speculating. Ooh, I don't have any wheat to sell, but I think the wheat market's going to go up, so I'm going to buy some call options. And then it's speculation. And most options, I think it's like 80% of all options expire unused. And that might just be in the egg markets. I'm not sure. Inflation, we don't hear much about inflation. And I'll tell you guys a story. When I was going to college, I worked in retail. And inflation at that time was so bad, literally we were changing prices on things. And that's when we had to physically change prices. You had your little pricing gun that you'd go around every week. Okay. Inflation was that bad back then that we'd go around and change prices every week. Now you could change them on the computer. It wouldn't be such a big deal. But inflation's been benign for the last decade or two, right? A couple percent maybe. In fact, the Fed keeps saying that they're trying to push things along and actually get inflation up to 2%. They'd like to see it at 2%. We can't even get it up to 2%. Okay, so inflation's pretty benign now, but it still has to enter into your decisions. In the old days, if you thought inflation, because inflation was pretty big, borrow all the money you could, right? Because you'd borrow money, and then you got to pay it back with money that was worth less, again, not worthless, but worth less in the future, right? Okay, and it made a lot of sense to borrow a lot of money in those situations. Now, that equation's not quite as simple, but there is still some inflation, and you got to take those into consideration. So. Some other modern issues. We already talked about inflation. Deflation could be a factor. We don't hear much about deflation. Deflation was huge in the Depression, of the 1930s. There was a huge deflationary thing that happened. Probably, if you go back and you read that, they say one of the biggest mistakes the Fed made at that time was actually they were kind of encouraging deflation, and it turns out that was the wrong thing to do. They should have been flooding the market with some cash, and they didn't do that, but that's after the fact, right? Required dates of return for capital budgeting decision, rates of return, not dates of return, rates of return. What do you want to earn? How much are you going to pay your shareholders versus those types of things? And the cost of capital. And you got weighted cost of capital, debt versus equity. And again, debt's cheaper than equity almost always. I say almost always now. Why did I change my tune on that a little bit just in the last year or two? The tax change made a big difference. Okay, before corporations were paying up to like 39 or 40%, depending on the state, for income taxes, you get to deduct interest, right? Okay, so if you're paying 10% interest, technically it was only costing you 6%. That's a real rough kind of way to look at it, right? But now their tax rate's down to 20%, and so that 10% interest is costing you 8%. So it actually made the cost of debt, having a tax decrease, made the cost of debt go up a little bit. Kind of one of those ironic little things that can happen when they change tax laws and whatnot. That gets to be a little bit confusing as a financial manager. In fact, I'll talk about that. Some of you will see it on your project too, probably. There was one, and it was interesting as heck. It took me a lot of research, which I kind of enjoy. I finally figured out what the heck was going on. But with the tax change, I was seeing some things on some of the financial statements, and the students were bringing it up, and we were looking at it, and I had to go, God, I don't know yet. I don't have to research that. And so I'd go and I researched it. And corporations have two different requirements, reporting requirements. One is they have to report to public corporations have to report to the SEC, or the Securities and Exchange Commission. That's a lot of the data that you and I want to look at in order to make an investment decision. But they also have to report to the IRS. Okay, and I'll make this quick to kind of tell you the difference. And if we need to get more serious about it, we can. We might when we get to Project 2. But what was happening, you've got companies like automobile companies. That's where I think this was showing up, automobile, or it might have been heavy equipment like Cat or John Deere or something. And they know when they sell vehicles that they're going to have, through experience, they know they're going to have a certain percentage of recalls and expense that are involved in those things. Okay, the SEC requires that they report that up front. So they have to report to you and I as investors that, hey, we sold $100 million worth of vehicles, but we know there's going to be a 5% loss on that in the future for recalls and those types of things. So we have to record for the SEC that 5% or $5 million loss, kind of, if you want to call it that, or expense. But the IRS says you can't actually take that expense until it happens. Okay? And so that gets to be a little bit confusing, and then all of a sudden that expense in the future has a value because you're going to get to deduct that from your taxes. Okay, so it creates what's called a tax benefit. This got really, like I said, this got really, really confusing. I had to read a lot to finally figure this out. But when the tax law changed, kind of like I was talking about interest rates, all of a sudden that tax benefit was reduced quite a bit. That future tax benefit was reduced quite a bit because tax rates went from 39%, 35, 36, whatever they were, down to 21%, I think. Okay. And so it really had an effect on a lot of those corporations for that particular year. It's a one-off thing. It really had no effect. It was just one of those paper juggling things, kind of, that really had no effect. But it was affecting what we were looking at, and that was kind of hard to reconcile. But it was kind of fun too to see what's going on. So learn something new anyhow. Creation, sale, mortgage. This was the recent financial crisis. When they say recent, we're talking the 2007, kind of 2009, the Great Recession that lasted probably longer than that. But this is what happened. We had unwarranted extension of credit, no doc loans, low doc loans, all kinds of things that were going on. Creation, sale, mortgage-backed securities, credit defaults, creation, la-da-da-da-da. Government actions and bailouts, we had those types of things. I was glad I wasn't in banking at the time. Our local banks, for the most part, fared pretty well because they weren't terribly involved in a lot of these mortgage-backed securities. And a lot of, again, you could teach a class for a full year, on just what was going on, during that time frame in terms of banks, some of these things. That was when you got some speculation going too with some of the hedging. You had credit default swaps and some other things that it just got pretty crazy. Okay, because of that, we've got some new regulations for financial institutions. Most of my old buddies that are in banking, they cringe when you bring any of those up because it has changed. A lot of them tell me it's just not as fun as it used to be. Sorry to break the news to you, Luke. They say it's just not quite as fun as it used to be. Now they regulate the heck out of us and whatnot. So 2010, after the crisis, right, they passed the Wall Street Reform and Consumer Protection Act, all kinds of things. The it's called Dodd-Frank. I refer to it as Franken-Dodd because, again, most of my old banking buddies, they don't appreciate it too much. So some of the things have probably been okay. I will also tell you that Trump's administration is trying to dismantle some of these protections that have been built into this, trying to simplify some things again, and they can and they should. A lot of this, some of these might be in your, in your quiz. I don't know if they will or not. The Volcker Rule, I don't. There used to be a law when I was in banking. In fact, it was called Glass-Steagall. And Glass-Steagall was a Depression-era law that came out, and it said, "Hey, a bank is a bank, okay? And if you're something other than a bank, that's got to be something other, right?" And banks weren't allowed, for example, to be involved in the securities markets really, and do some of those types of things. And they couldn't be involved in the insurance market at all. There was an exception for banks that were in small communities, because some of those small communities, that was the only place maybe people might be able to buy insurance and whatnot back in the day before the internet and whatnot. And so there was some exceptions, but there was this clear distinction between bank operations and other businesses, right? Well, they kind of got rid of that Glass-Steagall in, I think, the 80s, maybe the 90s, and that was part of the problem with the financial crisis, because then banks could engage in a lot of things. And the reason Glass-Steagall was there, it was a consumer protection for your deposits. You and I, we trust the banks. We put our money there. The government backs it right up to, what is it, $250,000, I think, now for account name or something like that. And so we trust them, and so they said, hey, if we're going to trust the banks, then the banks shouldn't be engaging in speculative activities that are out here that have to do with insurance and other things. They should stick to banking, which is taking in deposits and lending money, basically. Okay. Glass-Steagall kind of went away. The financial crisis came along. The Volcker Rule kind of brought back, I should say, a lot of those protections that they had from the Glass-Steagall. It kind of brought some of those back. And I don't necessarily disagree with that. Banks can still engage in those things, but I think they have to keep them separate. Okay, I think they have to keep the banking entity basically separate from other things that they're doing and not commingle any of those funds and whatnot. Okay, imagine it's a regulator's nightmare to go in and try to monitor those things. But the Bureau of Consumer Financial Protection was set up, and yeah, the internet, yeah, boy, has that changed things, right? Man, oh man, e-commerce for everything, right? This is what we see, the B2C, right? Business to consumer. We get on Amazon, we buy stuff. We get on eBay. eBay is actually consumer to consumer, but we get on there and we do those types of things, right? That's a fraction of what the internet does. B2B is where it's really at. Okay, that's what's changed. When I was talking earlier about inventory control and those types of things, man, that's all B2B, right? Okay, and those things are happening in the background. You hear about the cloud now, and we're using the cloud and we don't even realize it oftentimes. Okay, but that's become a big deal, and it's become a bigger deal again. B2B, right? Businesses being able to offer these kinds of services to other businesses. One of Microsoft's fastest growing business is called Azure. You guys ever heard of Azure? Okay, it's fast. It's a rapidly growing business, and that's just a cloud service business that they're offering to other business clients. What exactly it does probably depends on the client. I'm not real sure. Their main competitors are Google, Amazon. They've all got these cloud service businesses. IBM still does those types of things as well. Okay, very, very rapidly growing, and most of that is B2B types of things that you and I just don't see really on a day-to-day basis anyhow, unless we're working in that kind of an industry. Spurt of new business models, yeah, Amazon, eBay, Uber, Airbnb, Snapchat. What are some of the other ones? Lyft just went public not too long ago. How about Beyond Meat? That one's kind of interesting. Yeah. The old rancher shaking his head. I saw a good meme the other day. You'll like this one, Luke. It showed a picture of a steak grilling on the barbecue, and it said, that watery mouth you get, and that anticipation that you get when you got that steak grilling on the barbecue. It says, I wonder if vegans get that same feeling when they're mowing the lawn. Not to offend any vegans if we have any in the class, but I knew Luke could get a kick out of that one. E-commerce affects these things. You know, credit cards are going the way of the dinosaurs too, though, right? What do you guys use credit cards still to pay for things, debit cards? But where are we moving to? Your phones, right? You can use your phones, can't you, to pay for a lot of those things? Don't you? But a lot of people, Thomas is nodding his head, and yeah. Phones it's coming. Okay, and I've seen some people doing it. A lot of the credit card readers, you know, that the businesses have, a lot of them you can stick your phone right up to, and it'll just automatically debit your account just like a debit card would, or create a credit card type transaction just like a credit card would.
It's still like acting as a credit card, though, correct?
Basically.
It's just on the phone.
Yep, basically. Yep. Your phone's just carrying the same information that the.
There's the ones like out of Walmart. You don't even do the tap. You just scan the barcode,
Mhm.
and it just rings up everything and charges it to your account.
Yeah. Harbor Freight, Taco John's down here too. You can get coupons and stuff on your phone, and their reader there, you stick it in front of there, and it just automatically gives you the coupon rate, whatever the heck that is. So, yeah, it's that's where it's heading. Okay, that's absolutely where it's heading for now, anyhow. So, heck, 10 years from now, it could be completely different. Something else may come on, you know, that's even better. Might be biometrics. They're coming along. I think it's called biometrics, where the iris scan, the fingerprint, the voice detection and the ability to tell if it's your voice or not might be adequate. You know, who knows? I mean, those types of things are all in development. So, concerned with, right? Allocate funds to current or fixed assets. Yeah, sorta. You know, I would say most financial managers aren't necessarily the ones that make that decision, but the boss comes into the CFO and says, hey, we're thinking about building this new factory, you know, how should we finance that? Or should we lease, you know, or should we purchase? Those types of questions. Lay that on the CFO's, you know, desk. Excuse me, and then that's their job to go and figure out those types of things, right? Obtain the best mix of financing alternatives. Again, that has to do probably more with debt and equity. You know, what do you want to use there? If Apple's got $275 billion in cash, would they ever borrow money to maybe pursue some things like that? Sure. Again, debt's cheaper than equity. You know, they might maybe they got their cash invested in good things. And, you know, before they were doing a lot of that. This has changed again with the tax law a little bit. But up until 2017, companies that had a lot of cash overseas did not want to bring it home. Okay? Because they had already paid taxes on it overseas in those countries where they made the money. If they brought it home, they had to pay normal corporate tax rate when they brought it home to the United States. And so they just leave that money overseas. So a lot of that 200 and some billion dollars that Apple had was probably sitting overseas. Same with Microsoft, Cisco, different companies like that. Okay, and so they might want to do something, whether it's buy back some stock, buy another company, do different things like that, and they just go borrow the money. They got plenty of cash, but they could borrow the money here in the United States at 2% interest or whatever it was, and not have to bring that money back from overseas and pay a 35% tax, right? Okay, tax law changed that. I think they still pay a repatriation tax, but I think it's only 5% now. I'd have to look that up and see what the actual change was. And so companies are probably a little bit more willing now to bring some money back to the United States and put it to use. Appropriate dividend policy within context of that varies, right? This really varies. Okay, again, I go back to Warren Buffett and Berkshire Hathaway. He started the company in 1956. Guess how many dividends he's paid? Never paid a dividend. Well, why the hell would you want to buy Berkshire Hathaway if he's never paid a dividend? Well, because you get to leave the money with Warren Buffett, who's the best investor ever in the history of the world, right? And he's going to take that money and reinvest it. Why would I want him to pay me out a dividend? I'd just soon he keep it, right? That's number one. Number two, I don't have to pay any taxes on it then until I sell the Berkshire Hathaway stock. Okay, when he pays me a dividend, I got to pay taxes on that. That sucks. I don't like paying taxes. Okay. Other companies, on the other hand, pay dividends. Again, they have a lot of excess cash. You know, when Buffett has excess cash, he's looking. You know, he's looking to buy. You know, and Apple's got their excess cash. They're paying a dividend now, right? Apple didn't pay a dividend up until just a little bit ago. About the last 5 years, maybe they started paying a dividend, and they're buying back a lot of stock. Their dividend's still pretty low. Amazon, I'm pretty sure, doesn't pay a dividend. Amazon barely shows a profit. Well, how's that? They're worth $1 trillion, and in the last 15 years, there's only been a couple years that they've actually showed a profit, and it's been just real tiny. How do you do that? Well, it's just rapid growth in their case, right? And every dollar practically that they've made has been reinvested back into the company to grow it, build new things, build new businesses. You know, they're working on the delivery system now, right? They want to get so they can deliver to you same day type of thing. I don't know how they're going to do that out on the Cow Island Trail, but you never know. They might figure it out. So maybe drones or something will get it out there. But yeah, you know, so they invest that money back into it, and as a result, they haven't showed a profit really. It's very, 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 very small. Okay, very, very small. Daily things that you do, you know, daily, of course, those things, those are more bookkeeping types of functions, I would say, as opposed to financial manager. But stock issue and bond issues. Companies issue bonds, you know, as bankers. Bankers lend money to small businesses primarily, maybe medium-sized businesses in some cases, but large corporations, they issue their own debt, right? And that's what a bond issue is just issuing debt. Microsoft decides for some reason they might want to borrow some money, and there's Microsoft bonds out there, okay? And they just basically say, okay, we're gonna borrow money from you. Anybody that wants to lend us some money, we'll borrow it from you at 1.5%, whatever the case may be. And away you go. Okay, I'm oversimplifying that quite a bit. Okay, but it's basically pretty close to that easy. It is for Microsoft, right? And other companies that may be a little less profitable or a little less solid, they might have to pay a little more interest in that. They will have to pay more interest in that. Okay, capital budgeting, dividend decisions, those stuff, and stock buybacks. Again, I keep bringing that back. Independence Bank, from the time I worked at Independence Bank until today, they've bought back about half the stock that was outstanding. Okay? Not quite, I don't think, but about half the stock that was outstanding. They had a 10-for-1 stock split, so it kind of doubled the number of shares that were out there. But a stock split means nothing. Okay, it just changes the cost of the stock. They just did it because it was getting too expensive for employees to buy stock, because the price of the stock was getting up to what, I don't know, $3,000, $4,000, $5,000 per share or something like that. And so they did a stock split, brought it back down. The value of the stock, according to the last thing, was still $1,200 a share, so it's getting back up there again. But part of that too is that they have continued to buy back some stock. Okay, and so originally when I was there, the initial amount outstanding was 20,000 shares. 10-for-1 stock split should have taken that to 200,000 shares, but I think there's only a little more than 100,000 shares outstanding at Independence Bank, if I'm not mistaken. So somewhere in that neighborhood. So okay. So what happens for smaller corporations? Independence Bank's not a publicly traded company, by the way. Okay, it's a private or closely held corporation. Okay, so there are probably, I don't know, 200 shareholders, something like that. Maybe that own some stock in Independence Bank. Kind of a difference. Could we go online and look up the information for Independence Bank? Yes, but only because they're a bank, not because they're publicly traded. Okay, banks have to report too, and so you can go to the FDIC and look up all that information that you want to. Risk return trade-off. Risk goes with return always. Risk and return go together all the time. Forms of organization should be back to your business law a little bit, right? Hopefully you guys studied a little bit of forms of organization when you went through business law. I don't teach that anymore, but when I did, we talked about this, right? Proprietorships, sole proprietorships, just one person, okay? They're all pass-through entities except a C corporation. We'll talk about that a little bit. But they're all pass-through entities, meaning that all the profits and losses are reported by the owners as their own in terms of taxes. Okay, so they're called a pass-through entity. Unlimited liability. Okay? Unlimited liability. So that means that if you're a sole proprietor and something happens and the business gets sued, guess what? You get sued too, right? You may be held responsible for that personally. Okay? Corporations, LLCs, and a few other, these are a little bit different. So I kind of want to, let me try to get through the forms of organization, and then we wanted to look up market value and those types of things. So partnership, similar. Okay. There's different types of partnerships, though. Okay, a general partnership, everybody has unlimited liability. Again, in a general partnership, everybody has unlimited liability. Okay, there's nothing required to form a general partnership. A lot of partnerships have, they've got agreements and whatnot, but there's nothing required. I've been partners with a guy for 25 years on a little land that we own east of town. We've never had a written agreement. We barely talk. About once a year, a couple times a year, we get together and have a little BS session, have a beer or something, and works out fine. Nothing wrong with that. Okay, but that one's pretty basic too. A lot of partnerships, you probably want an agreement or whatever. There are limited partnerships where you'll have a general partner, but the limited partners are only making an investment. They don't participate in the management, and thus their liability in those cases is limited. And that's a huge thing. Corporations, there's two types of corporations. There's C Corps and S Corps. Okay, C Corps are the ones that we're kind of familiar with. When we talk about publicly traded corporations, they're virtually all C corporations. Okay, they're virtually all C corporations. Okay, C corporations have the drawback that they're double taxed. Okay, remember when I said, if Berkshire paid me a dividend, I'd have to pay taxes on it, right? So that's once. But guess what? Berkshire's already paid taxes on that income too, right? Okay, so that's kind of called double taxation when that happens. S corporations, that doesn't happen. S corporations are called a pass-through corporation too. Pass-through entity, just like a partnership or sole proprietorship, meaning that the tax burden or the tax benefit gets passed through to the owners in that case. I know this is a quick, run down through this again, but hopefully you had this, and this is just a little bit of a repeat. Nice thing about corporations, yeah, easy to divide it up, right? I can own one share of Independence Bank, okay, or 2 shares, or whatever the case may be, right? Or I can own 1,000 shares, okay, and so you can divide it up pretty easily, and that's kind of nice. Some of the others are a little more different. Then you got percentages and this and that. Again, the potential double taxation, but S corporations, and that's all. It's truly just an election. But there's limitations on S corporations. Okay, big corporations that have a lot of shareholders cannot be S corporations. Okay, there's a limit to the number of shareholders that you can have. LLCs, I would tell you, are probably have become the most popular form of an entity, maybe outside of a sole proprietorship. Okay, LLCs are relatively easy to set up. They don't have a lot of the requirements that a corporation does, but you still have the liability protections that a corporation has. And so they're kind of a hybrid. They're called with a lot of the best things from all the different entities. They're still a pass-through, so you don't have the double taxation. Okay, so a lot of folks have been setting up LLCs. You don't see that. Farms and ranches still in north central Montana, a lot of times are C corporations. That gets back to one quirky little thing that's kind of a tax loophole for them. It allows farms and ranches, you can write off living expenses if you're a C corporation. And so a lot of the local farms and ranches are actually C corporations instead of LLCs. And again, that's just kind of a quirky thing, a loophole that's been found that farms and ranches take advantage of. So let me stop there because I said I'm going to maybe look up Apple. By the way, when we get to Project 2, Morningstar, I think I said, is probably one of my favorite sites to go to look up information on corporations. FINRA is another one. Actually, I probably use FINRA as much or more than Morningstar. Morningstar is a little easier to get to. So I come up here, I get to Morningstar, and I type in AAPL, which is Apple's ticker symbol. All companies have a ticker symbol. It's 1 to 4. letters that go along with the company. It was up $1.34 today. Okay. Bid, ask, days, range, volume, market cap. Well, it's gone down because they were up about $230 a share, and that's when they were about $1 trillion. And so now they're about 205. Market cap's only $928 billion. Okay. Now I got to come down. I got to go here to their financials, and we'll see what their book revenue. I probably have to get into, if it's going to do it on here, if I go balance sheet. 2018 is the most recent. They got total current assets of 131. How come I said they had so much cash? Well, I think down here they also got 170 billion in investments. They're showing that as a long-term asset, but you add the 170 and the 130, God, that's almost $300 billion probably in cash and cash equivalents that they're sitting on right now then. So, okay. Total assets are only 365. So of their total assets, 300 billion of it is cash, roughly. And some of those investments could be things other than cash, so I can't divide all that out just on this. And they've only got about 66 billion in other assets, and so their book value then is total equity. You said it's got total liabilities of 258, so they've got some liabilities there, a little more than I thought. Total equity is only 107. Their book value is only 107 billion. That's actually kind of gone down a little bit. Isn't that interesting? On a company that the market says, though, is worth nearly $1 trillion. Okay, but that's based on their earnings potential, right? I mean, they're earning money like a son of a gun. Okay, they're just throwing out cash like you can't believe. What was the other question we had about Apple or cash on hand, market versus? Yeah, I can't remember. I thought there was something else that we were going to look at. We could look at their dividend, but okay, I'm past time. Sorry. So we'll wrap it up, call it a day. See you on Friday. Next week, you want to get starting to look at your guys' problems for the assignments for the next chapters. See you then. Have a good evening.